Investing in the stock market can get pretty confusing. There is a lot of strange lingo and a lot of new ideas that you need to get accustomed to. That's why today I'm going to be talking about the basics. First, I'm going to explain a little bit about investing in general, what it is, and the different types of investments that you can make. Then we're going to get a little more in depth about the stock market, shares, and picking stocks. And finally, I'm going to address some common questions that I hear from many beginning investors. Let's get started. So what is investing? In short, investing is a way to make your money grow into a larger amount of money over time. This is done by buying assets that you expect to appreciate or gain value over time. And there are many different types of assets that you can invest in. Most people think of the stock market when they hear the words invest or investment, but the truth is, investing is not just limited to Wall Street. Many people invest in cryptocurrencies, rental properties, fine art, and even comic books. These are just a few examples of alternative investments, but the truth is there are many more options out there in the world today. And even when you look at the stock market alone, you have investment choices. So let's take a look. If you want to invest in the stock market, then it is vital to understand what stocks are. Stocks, which are sometimes referred to as shares, are small pieces of a company that you can buy on a stock market exchange. So while you might not own enough of the company to be considered for a board member position, you do in fact own a small piece of the company that you invested in. Because of this, you're usually granted voting rights on major decisions in the company. Just remember that it's usually one vote per share. And it's important to know that generally, your stock value may increase if the company you invested in does well. This is actually a really big part of how people make money with stocks. Fractional shares. Fractional shares are relatively new to the whole investing scene, but they're exactly what they sound like. Fractional shares are a fraction of a whole stock. This can be pretty useful since some companies have shares that are absurdly high, like think thousands of dollars. And while fractional shares make it easier to invest in some companies, there are some downsides. First, not all companies have shares that are available for fractional trading. Only some do. Second, if the time comes that you want to cash out, it may take you longer to sell your fractional shares because they might not trade as often as whole shares. Still, fractional shares make it more accessible for more people to invest in more profitable companies. Dividend stocks versus growth stocks. Dividend stocks are stocks that pay a portion of their earnings out to shareholders in the form of dividends. This money is usually paid out on a regular basis, for example, quarterly or annually. Dividend stocks are typically issued by established, stable companies with a history of steady profits. On the other hand, growth stocks are stocks that are expected to grow faster than the overall market. These companies typically reinvest their earnings into the company to fund expansion and growth instead of paying out dividends to shareholders. Growth stocks are often issued by newer, smaller companies in emerging industries. The tech industry is a pretty good example of this. With dividend stocks, investors can receive regular income in the form of dividends, which then can be reinvested or used to supplement their personal income. With growth stocks, investors are mostly focused on long-term capital appreciation, or gains, as the company grows and expands. It's also really important to mention that dividend stocks tend to be much less volatile than growth stocks. This is because, as I hinted at earlier, dividend stocks are usually issued by established, stable companies that are less affected by overall swings in the market. Growth stocks, on the other hand, tend to be more volatile because they're issued by smaller, newer companies that are much more sensitive to swings in the overall market. Public versus private companies. So not all companies have stocks that are available for purchase. This is because not all companies are public companies. Some companies are private. Although some private companies may have made stock available to their employees or private investors, that stock is not available to trade on any stock market exchange. On the other hand, public companies have likely gone through the IPO process. This is the initial public offering, and their stock is available for trade on a stock market exchange. Brokers. Stock market brokers are individuals or firms that help you buy and sell stocks and other securities. They act as middlemen between buyers and sellers, making the exchange of stocks and securities possible. And there are two types of brokers: full-service brokers and discount brokers. Full-service brokers are what you would choose if you're going to go to the more traditional route. These brokers offer a wide range of services, including investment advice, research, and portfolio management. However, because they provide much more comprehensive services, they charge much higher fees. Discount brokers, on the other hand, offer less services and charge lower fees and commissions. They typically focus solely on executing trades on behalf of their clients. And because of their affordability, they become a really popular option. In fact, many retail investors prefer to use popular fintech apps like WEBULL. WEBULL makes it easy to invest in stocks, options, ETFs, and even crypto, all commission-free. You can access your account info and detailed market information on their sophisticated desktop application or by using their convenient mobile phone app. You even have the choice of opening up a regular brokerage account or a retirement brokerage account, such as a Roth IRA, traditional IRA, or rollover IRA. But whatever you choose, you can get up to 12 free stocks when you open up an account with WEBULL and fund that account with any dollar amount. To learn more about WEBULL and to sign up, click the link in the description below. How to pick stocks. So you may be wondering at this point, how do I pick which stocks I should be investing in? And you might be surprised. The answer to that is actually pretty simple. You don't. There are tons of people out there that are going to tell you exactly which stocks that you should be buying, selling, or holding. And these people will even tell you that if you don't follow their method, you're wrong. And you'll see people like this on the TV, but you'll also find these knuckleheads on plenty of online forums and comment boards. What they'll conveniently forget to mention, though, is that they are probably consistently hemorrhaging cash and taking sizable losses. So should you really be listening to them? In my opinion, not at all. Instead, it's much better to take advice from experienced and successful investors. And in fact, the Oracle of Omaha himself, Warren Buffett, recommends the average person to stay away from stock picking altogether. He says, "The trick is not to pick the right company because most people aren't equipped to do that. The trick is to essentially buy all the big companies of the S&P 500 and to do it consistently and do it in a very, very low cost way because costs really matter." And that's true. Over time, those higher interest rates are going to really eat into your retirement fund. That's basically what he's saying. So yes, the truth is, as an average investor, you should probably steer clear of stock picking altogether and instead start dollar cost averaging into the S&P 500. Index funds are investment funds that track a specific market index, like the S&P 500, the Dow Jones Industrial Average, or the NASDAQ Composite. They're usually passively managed, which means that they don't involve stock picking or market timing by any fund managers. Instead, index funds try to match the performance of the market index that they track. This makes them a lower cost and lower risk option for investors who want to invest in the stock market without taking the risk of researching and picking stocks. Index funds usually have lower fees compared to actively managed funds, and this can make a huge difference in the long run, especially for long-term investors. By putting money into an index fund, investors can spread their bets across different stocks in one market or industry. That way, they don't put their eggs in one basket and they can spread the risk across all these different securities. The S&P 500. Standard & Poor's 500, or the S&P 500 for short, is basically a list of the top 500 biggest companies in the United States. This list covers lots of different industries and people use it to see how well the market is doing overall. It's also a really good way to invest in the United States economy. Over the long run, this index has historically been one of the strongest performers in the entire stock market. And if you want to invest in the S&P 500, you can do that through index funds. These funds track the S&P 500 and they're great for regular people and big investors because they let you invest in lots of different companies all at once. One of the most popular funds that tracks the S&P 500 is called the SPDR S&P 500 ETF. But you might just want to call it by its ticker symbol, SPY. Another popular index fund that tracks the S&P 500 is the Vanguard S&P 500 ETF. That ticker symbol is VOO. How to buy index funds. You can get your hands on your very own shares of SPY and other index funds that track the S&P 500 by working with a broker. Some of the easiest brokers to work with are conveniently available on your phone or your personal computer. And I know I mentioned this earlier, but I personally use WEBULL. I prefer WEBULL because they provide in-depth market data and up-to-date news feed, and they make it really easy for me to search for exactly the stock or index that I'm looking for. I can quickly see how the S&P 500 is doing on the Markets tab, and I can search for and trade shares of SPY quickly and easily. If I feel like I need to brush up on my investing education, WEBULL also has an entire learning section that helps me gain knowledge about many different investing topics. If you want to learn more about WEBULL or you want to sign up to get your free stocks, then click on the link in the description below. Understandably, many newbie investors have some very valid questions when they're starting to dip their toes into the stock market, and you may be no different. So let's talk about a few of the most common concerns that tend to pop up. What if the stock market crashes? You have to remember that investing is a long-term commitment, not a get-rich-quick scheme. Warren Buffett has said, if you aren't willing to own a stock for 10 years, then don't even think about owning it for 10 minutes. It's very easy to get caught up in the idea of getting rich quickly. And truthfully, if that's your focus, and if the stock market were to crash, then chances are you might panic and sell all of your shares at a loss. By doing so, you would lose all of your money. But if you're playing the long game and investing in the S&P 500, then it doesn't really matter if the stock market crashes. Theoretically, you would just keep holding your shares, and as time went on and the market crash ended, your shares would gain in value again, and you wouldn't lose any money. So I guess that old saying is true, that good things come to those who wait. Usually. Are there better investments to make? Maybe. Investing is actually very personal, and what works for one person might not work for another. You need to take a good hard look at your finances, your values, and your overall goals to decide what investment strategy is right for you. I'll be honest, that could even mean that you might need to hold off on investing altogether while you focus on paying down your high interest rate credit cards. For someone else, it could mean that maybe instead of investing in the stock market, maybe it's the right time for them to invest in real estate. Or who knows? Depending on your situation, maybe now is the right time to invest in the stock market. Only you can decide what's best for you. Who can I talk to for advice? Now, while I can't offer you any personal advice, if you do need financial advice, you'll want to seek the help of a qualified licensed professional. And that's a really important distinction to make, because as is the case in many professions, financial advisors are a dime a dozen. You might even be surprised to learn that many of them have little to no experience at all with any investing whatsoever. And this is not a good thing. I cannot tell you how many times I've seen terrible advice given to people by freshly licensed financial planners. It's shameful, truly. But the best thing you can do to avoid this and to protect yourself is to do your research. Make sure that when you're looking for a financial advisor that you're not just checking to see whether they're licensed or not, but you want to make sure that they have a solid track record. Check to make sure that they've been in the industry for an extended period of time, and look for client reviews on independent websites. Now, I know I've covered a lot of information today, but if you've learned something new, then why don't you go ahead and hit that like button? It really helps with the algorithm so that I can keep sharing these videos with more people and spreading good financial education to the world. And if you haven't done so already, why don't you hit subscribe, and that way you can keep seeing more videos like this. Finally, I just wanted to ask one question. What are your plans? How are you going to invest? Are you going to invest in the stock market now? Are you going to invest in real estate? Are you going to hold off a little bit? What is your plan? Why don't you go ahead and share that in the comments below? Thanks so much for stopping by. I will see you next time.